Well, hey there, everyone. Happy Wednesday, February 25th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, with Market Misbehavior, coming to you from a lovely sunny winter day here in Redmond, Washington. Hope you guys are all doing well wherever you're tuning in from. Thanks so much for watching on this fantastic bull market breakout day. I guess the breakout depends on what chart we're looking at, right? The S&P 500 remains range bound. We're not seeing the major averages break out just yet, but a lot of optimism going into the close through the course of the trading day. We're seeing cryptocurrencies rip higher. Coinbase, which we highlighted, is essentially a leverage play on Bitcoin and Ethereum, having a monster double-digit gain day, bouncing off of previous lows. NVIDIA's earnings after the close appear to be fairly decent, beating on the top line revenue number and trading higher in the after hours. Will this be enough to propel the S&P 500 above that 7,000 threshold that has been an elusive target to the upside? That remains to be seen. It didn't happen today, but we will show you what happened in the major averages. As usual, we'll go through three parts to the show. We'll start with just a quick update on what happened in the markets today. We will look at the heat map, focusing on sector and group themes within the S&P 500, and then we will finish off going through some charts I've hand selected through the course of the day to share with all of you. I appreciate you guys, as always, tuning in, liking the video, dropping a question in the comment section of our YouTube channel. We'd love to hear from you, as always. So, decent day for risk assets. That is my main takeaway from today's session. The S&P trading as high as 69.50, closing just slightly below that at 69.46. That's up 0.8%. from Tuesday's close. The Nasdaq Composite up 1.25%. Mid caps and small caps both lagged. We are back to growth over value. We are back to offense over defense today. All of that optimism with risk assets moving higher enough for the VIX, the fear gauge, to go back in a not so fearful range, going down another 1.6 VIX points to just below 18. So the VIX sort of drifted lower through the course of the day as the S&P and the Nasdaq generally drifted higher. So this is a nice day going into NVIDIA's earnings. Certainly plenty of optimism being reflected on the charts of growth stocks. And when I'm looking for stocks making new 3-month highs today, a lot of tech in there, a lot of a lot of semiconductors. Not all semiconductors though, and certainly some other areas of technology. Some charts we've highlighted. One that I grabbed that I'd not looked at very often, making a new 52-week high today. We'll finish this show with that particular chart. But there are plenty of things breaking out, and that has been the reality of this market all during the consolidation phase, but certainly today fueling some nice fresh breakouts across the board. Rates, as we've been talking about, have been generally drifting lower as bond markets have been rallying. Today was a bit of a pause there. The TLT was basically flat for the day. The dollar ETF, the UUP, was basically flat for the day. Rates generally drifted higher, but not by much. The 10-year yield finished today right around 4.05%. The long bond yield is at 4.7%. Kind of a crazy day in the commodity space. There's an issue in the at the CME, the Chicago Mercantile Exchange. So trading was halted in some futures markets, including metals futures, for a little while. I think it was over an hour, 30 minutes, 60 minutes, something like that. But enough to really kind of shake the markets up. So they were actually doing okay. And then after the market reopened after that pause, they rotated lower. So it's hard to tell if that was more of a structural kind of panic, type of thing, or more of a, risk off kind of move. Certainly during that period when the metals markets were closed, equities were just kind of drifting higher. Cryptocurrencies were drifting higher. For what it's worth, gold, silver, most of the commodities kind of, rotated lower pretty aggressively in the afternoon. The GLD actually finished slightly negative by about 0.25%, and silver ended up positive, but gave back a lot of the earlier gains just in the last hour as stocks rotated higher. Crude oil prices lower a little bit. Energy had a decent day, but not particularly good. Cryptocurrencies looking fantastic today. Look at some of the returns, double-digit gains in some of these cryptos. These have been pretty underwhelming charts for quite some time. Bitcoin has now bounced off of 60,000 and just touched 70,000 briefly as we are prepping for the show here. Bitcoin currently trading just above 69,000. That's up almost 8%. Ethereum prices up 14% to 2110. You can see the rest of the top 10 coins on the stock charts platform in the green. So very much a bullish rotation to the day here for risk assets. Some of the more volatile assets like cryptocurrencies really accelerating to the upside. The question, on charts like Bitcoin and others, are they sustainable, right? And that's what happens when you have a market in a primary downtrend. You have this big, huge, sudden up day. Is that enough to change the complexion of the chart? That's the nuance, right? That's what we'll try to assess as we look at the chart of Bitcoin. Big round numbers on charts like Bitcoin tend to have pretty important meaning. So 70,000 could be an important level here to watch for sure. Looking at the 11 S&P sectors, kind of a coin flip, half up, half down. On the upside, you have technology up 1.9%. A lot of optimism going into NVIDIA's earnings. Looks like for now that optimism was justified, and also another general move higher in risk assets after the State of the Union address last night. There's talk of the president inviting technology CEOs to the White House next week to talk about the assertion that he will make them pay for AI infrastructure. We'll see how that actually plays out and what the implications could be. But for today, technology getting a nice bid, up 1.9%. Financials, number two, up 1.8%. That's been a pretty rough sector here in 2026 and certainly in February, so that's good to see. And then utilities, third from the top, up about 1/3%. On the downside, consumer staples, one of the more defensive sectors, and some of those charts had been looking very, very good. Like TAP comes to mind as a pretty impressive breakout that now has stalled out a bit. I did grab a couple of those charts just to talk through and show you examples of what's happening in that sector. The industrial sector down 0.8%, real estate down about 2/3% as well. So kind of a growth versus value, offense versus defense day, but honestly pretty mixed, with half the sectors up and half the sectors down. The breadth was not particularly awesome either. It was good, right? It was good, not great, is how I would describe it. The New York Composite Index, 56% of that index was up compared to 41% down. The Nasdaq had much stronger breadth, obviously with a growth-led move today. You're going to get stronger breadth in the Nasdaq, but in the S&P, almost dead even between advancers and decliners. So what happened today, right? Those big growth names that have been struggling have been weighing down the major benchmarks. They've been keeping the S&P 500 flat as the other sectors like industrials, materials, energy, consumer staples, healthcare, et cetera, have been doing much better. Now we get a mean reversion to that trade as some of those value sectors taking a breather, the growth sectors rallying, but as a result, the breadth not as good. So this is one of those weird times where the breadth is almost counterintuitive. Strong breadth probably means weak benchmarks. Weaker breadth means stronger benchmarks for a particular day. And that's because the breadth strength is really speaking to the strength outside of technology. And if tech and growth are working, the other stocks generally have not been. And that's why the market is moving higher, but the breadth doesn't look nearly as good. Looking at the Magnificent Seven and Friends, the key growth names here, Netflix, having the best day of all of these. Can't remember the last time I've said that sentence, but here we are, up 6% today to just below $83 a share. That's pretty nice. Microsoft getting back about $400 a share. That's up 3%. Meta up 2.25%. Broadcom up 2.1%. Worst performers, and they were all up, Alphabet, Apple, Amazon, all up 1% or less. And NVIDIA, pretty decent day, up 1.4% going into earnings. We'll give you the update on what's happening after the market because it is trading above $200 a share as an initial reaction to what appears to be a pretty good earnings beat. We'll see what happens on Thursday and Friday to complete the week. All right, we're going to get on to some heat map analysis. As a reminder, your questions are so valuable and so welcomed. And I appreciate you taking the time to ask a question. You can do that using the comment section on our YouTube channel. We're planning an all mailbag episode later this week, and we would love to answer your questions. Just as a heads up, I'm actually going to be traveling the next couple days, doing the what most likely is the last college tour with my high school aged daughter. So I'm going to be flying across the country tomorrow, and then doing some college stuff on Friday and Saturday. So please be flexible as I try to find time to put a show out there when conditions present themselves. And I'll try to let you know on social media and through our YouTube community when I'm able to do so. By the way, best way to stay in touch with the show and what we're doing on our YouTube channel, just subscribe to the YouTube channel. We do put out a lot of comments on the community there, and if you're subscribed, you'll see all those notes. We'll try to update you on when the show will be available as soon as we're able to do so, but probably later than usual tomorrow. All right. Looking at the heat map here, what stands out? I mean, number one, obviously the strength in tech. I mean, NVIDIA, a good update, but the better up days were elsewhere. We had talked about how some of the hard drive names, Western Dig, WDC, Seagate Technologies, STX, had been pulling back this week. Nice bounce higher in both of those names. STX up 6.5%, as we can see there. Western Dig up 7.5%, pretty close to making a new high. That's impressive. A lot of strength in semiconductors. NVIDIA was kind of one of the worst ones. AMD down slightly, but you can see a lot of these like AMAT making a new high. KLAC trending in the right direction. What's another one that I was going to highlight? I was looking at a couple of these earlier. I forget the other one. Who knows? It's boy, if I don't write things down, they just disappear out of my head. It's amazing how well that works. So outside of the semiconductor space, obviously a lot of green and a lot of other technology areas. JBL is one that I've been talking about recently. A couple of weeks ago, we did our stock picking competition. Tom Boley and Grayson Rose and I for earnings beats and stock charts, and I was super excited to participate. I had two technology names in the portfolio, and JBL was one of them. That's been probably the best chart that I selected so far out of them, and it great example of stocks within technology just continuing to look quite strong. And again, as long as the trend continues, higher highs, higher lows, those are good charts. Other thing to observe, obviously the financial sector. Now, some of these have been testing support, right? JP Morgan testing support right around 300 and bouncing a bit higher here. A number of these big banks like Bank of America and others have been in a pullback mode, all of them testing support. Some of them have held for now, some of them slightly breaking down, all bouncing higher today. I think those charts still have quite a bit to prove before they look like really good charts again, but getting a nice breather. Visa and MasterCard both up about 2%, but these are, coming off of pretty low levels. So not the type of charts I'd be super excited about taking a shot at just yet. And then others, I would say the regional banks come to mind. We'll come back to Coinbase because I have that one. Regional banks are interesting because that's sort of a play on the yield curve. These stocks have been struggling as bonds have been rallying, as the long end of the curve has been coming down. Today, sort of the opposite. And so those regional banks are having a nice bounce as well. So for one day, getting a nice bounce in some of those names, but still, I think too early to declare those, mission accomplished. They're back to thumbs up types of environments. That's what's good today. What's struggling today when I'm looking at the heat map, communication services outside of the big three, right? So the three biggest weights in the communication services, Alphabet, the largest, followed by Meta and Netflix. Then you get into some of the old telecom and mobile names like T-Mobile, AT&T, Verizon, some of the media names like Disney, Comcast, Warner Brothers. All those top three names had a pretty good day today, and then everything else had a pretty rough day. And so that's that's kind of happened a lot in communication services. You have sort of the internet part, and then you've got the other part, and when one is up, the other tends to be down, and the opposite. So we're back to the growthy stuff working, and the non-growthy part of communication services struggling a little more. Other things that stand out on the negative side would be in the industrial sector. So names like John Deere, and granted, I would say these are still pretty good charts, but they're just pulling back pretty good today. John Deere is an interesting one to think about because this is a dangerous chart because it's starting to look more like what I call a gap and fail pattern, right? So when you have a gap higher, this is the uptrend has been in place, really from the end of December on. Nice uptrend. You see this turned on a dime and just started accelerating higher. We got to earnings, and we gapped higher on earnings. But for now, that's been the peak, right? The high of that earnings date. And that's not what we want to see with a stock in a strong uptrend. We don't want to see that strong earnings, the great upside reaction, and then it totally stalls out, because what that implies is that like the last buyer has now bought, and who's left to propel this stock higher. What you want to see is a gap followed by further accumulation, right? We want a gap and run where the gap is followed by additional buyers. And there's so much optimism that even though we liked buying it at 600, we're even happy to buy it at a 10% premium when it's at 660 a day later. What we're seeing here is the opposite, where it looks like that strong earnings beat for now is the peak, and we're seeing sellers dominate after that earnings. So it implies sort of a skepticism, and investors thrilled to cash out on the recent strength in John Deere. Now we're back into the gap range, and when I'm looking at charts like this on stock charts, I usually use this like a shaded area like this, just do a rectangle and kind of highlight the range of the gap and sort of save that on the chart. So on chart lists that I save, I'll keep an eye on that gap, because more often than not, like if you look back here, more often than not, that gap ends up serving as like support and resistance, right? So here was the gap down in August of last year. Look how after that bounce to the 200-day, we traded right up into the range, right? So that gap sort of serves as a resistance range. Then we sold off again, we rallied, we hit resistance again. Look how many times we're kind of stalling out, getting into that resistance range. Then when we finally break out, that's a sign that we're in a good breakout situation. So I think almost the opposite is kind of happening here, where you have this gap, and we want to watch that for potential support as we pull back after the gap higher. So John Deere becoming a pretty compelling chart, and not in a good way here. We've seen a lot of red elsewhere within the industrial sector. We don't have time to go through all of these, but a number of these stocks, like a Masco, just made new 52-week highs earlier this month and starting to come down from there. So could be the beginning of a rotation away from industrials, which would be certainly a shift from what we've observed so far in 2026. Finally, a lot of red in consumer staples. We've highlighted some of those, as we mentioned earlier, with TAP, pulling back. A number of those names have had pretty constructive charts, but starting to give back some of those recent gains. And so certainly an area to watch. But boy, tobacco continuing to run higher like it doesn't even care. That's impressive with the chart of Philip Morris. All right, we're going to get to some charts that I've hand selected in a moment. As a reminder, I want to thank our friends at Coherent for being great partners here. You can find more information about their platform at marketmisbehavior.com/Coifin. This is a platform that I use every day. I use it mainly for ETF holdings and attribution analysis. Great for portfolio analytics, great for non-US markets. Good mix of fundamental and technical data. A lot of my process is technical, but I do consider the fundamentals, opportunistically when I think it's part of the story that I want to understand a little bit better. And that's one of my go-to platforms to help make sense of that. If you're a financial advisor, they have some great tools to help enrich a relationship with the client, visuals to take market data and turn it into something meaningful, so you can help a client understand their portfolio and what kind of bets they're making, what kind of risks they're exposed to. You can learn more and take advantage of their 20% offer for new members if you go to marketmisbehavior.com/Coifin, Koyfin, or just scan the QR code you see next to my face on the video. All right, let's finish off looking at some charts here. I think I had this ready. Here we go. Looking at the daily chart of the S&P. So again, we're just sort of chopping all around this sideways range. We've been revolving around 6,900 now, going back to the end of November, right? If you look, that was we first hit 6,900 in October. We pulled back. We retested 6,900. We pulled back. We went above, below, above, below, above, below, and now we're back to above. So we're literally just oscillating around that 6,900 level. I mean, talk about a swing trading, dream here. You've got clear support at 6,800 that continues to be validated. We've got clear resistance at 7,000, which keeps being held. At some point, the S&P, as we discussed on yesterday's show, is going to break out of this range and break above resistance or break below support. And I would say looking at the RSI in that breakout scenario is going to be vital, because an RSI above 60 with a break above S&P 7,000, pretty bullish. A break below S&P 6,800 with the RSI dropping below 40, pretty bearish. And anything in the middle is sit on our hands and wait, which is where we remain. The good news for investors is underneath the hood, there are plenty of stocks breaking out. There are plenty of stocks breaking down. There's, I think, plenty of opportunity to differentiate a portfolio with strong momentum characteristics, but it is netting out to our benchmarks being fairly neutral. Now, my process is all about analyzing the trends and defining the trends and then actively monitoring for changes in those trends. And with that in mind, I want to highlight one thing that's changing here this week. This is the bullish percent index on the Nasdaq 100. I was just interviewing Clint Sorensen of Ascentus Asset Management for the podcast earlier today. That episode hopefully will be out for you tomorrow. Really good interview. This is someone with a CMT who's a financial advisor, uses technical analysis heavily as part of a really disciplined research process, but also is working with clients and understands how we want, how you can use charts to tell a compelling story and enrich that relationship. And one of the indicators we talked about briefly was the bullish percent indexes as a way of measuring breadth. The bullish percent index in this case is looking at the Nasdaq 100, those 100 leading growth names, and looking at every one of the point and figure charts. Is the most recent signal a bullish signal or a bearish signal? And this is the percent of those 100 charts that are currently showing a bullish signal as its most recent signal. It was down around 38% the first week in February. Now, as we get toward the end of February, it's up to almost 60%. And just this week, it spiked above 50%. So we're seeing quite a number of leading growth names, NASDAQ 100 members, getting a buy signal on their point and figure chart. That shows a rotation back into tech, the likes of which we haven't seen so far in 2026. And this could be the momentum, could be the breadth improvement that causes the S&P to go above 7,000. Certainly could cause the NASDAQ to start to outperform again. Outside of technology, what's happening? We mentioned some of the issues in the commodity space today. It was sort of a weird, structural day because of the CME having a technical issue, open and close air quotes. I don't know specifics of what that was, but I'm sure there were some super frustrated traders waiting for the market to reopen. And there's nothing worse than thinking the market's going to be open and it isn't, if you're a trader, I would imagine. But those challenges aside, what has that done to some of the commodity charts? Well, crude oil has rotated lower this week. We can see crude oil down again today. And it looks like we might have a failed breakout above the $66 level. We highlighted this stepwise motion as crude oil in early January got to $59 a barrel, broke out and retested it, got to $62 a barrel, broke above it, retested it from above. Now we're breaking above $66 a barrel. We really didn't follow through much higher in the way that we saw in early January and late January. So this almost looks like a failed breakout above $66 a barrel. If we do get more of a pullback, a 38.2% retracement of this uptrend leg would take us right to the 200-day moving average, right around 62.50. So for me, that's a reasonable kind of downside objective. That 62.50 range. If we would get back there, I think that's an opportunity. That's where you could probably anticipate some sort of meaningful support. But for now, important chart to watch because a lot of energy stocks have done quite well in 2026 because of the strength in crude oil. If that would show weakness here, we just want to make sure we follow key support levels. Some of the ones I highlighted there are the levels that I'm watching. Bitcoin having one of the better up days that we've seen. We saw first week in February, we had a big upside reversal as Bitcoin touched 60,000 for the first time in many, many moons. We kind of rotated back down toward those levels. We got down to around 62,500. And then today we're having a nice upside rebound. Now it looks like we're stalling out for now right around 70K. That's where we stalled out about a week and a half ago. So getting back above 70,000 would be a good short-term kind of tactical level. And if that would happen, I'm watching the 50-day moving average currently just below 80,000 for Bitcoin. But a break above 70K could be an interesting signal, an upside reversal, which we haven't seen in quite some time on the chart of Bitcoin. Now, we highlighted early this week, I want to say, or last week, how Coinbase essentially has been a leveraged play on Bitcoin, right? When Bitcoin's up a good amount, Coinbase is up a lot more. And you can see that today, right? Bitcoin currently up, around 7.5%. Coinbase during the equity trading session up almost double that, up 13.5%. So Coinbase back above the 21-day EMA. Last time we did that was back here in early January. We kind of stalled out as we hit the 50-day moving average. So that's a level to watch. That's currently just above $210. Maybe that's an upside swing. That'd be another 30 points above today's close, 28, 30 points. So maybe some short-term potential upside there for Coinbase, given the strength off of those lows. However, a higher low and then follow through with stronger momentum is what really would make me more of a believer on this chart. RSI needs to get above 50 and definitely above 60. That would be a more encouraging rotation on the chart of Coinbase. All right, we've spent enough time not talking about NVIDIA. Let's go there. We highlighted on yesterday's show and earlier this week some of the charts we're watching on NVIDIA. I did a show for Stock Charts TV yesterday where I shared 5 different charts related to NVIDIA, monthly, weekly, daily, and then a couple other charts as well. Point figure chart we went through, also looking at some volume indicators. So check out that video if you want more color on how I'm sort of thinking about NVIDIA around earnings. But let's quickly update on what the chart has been telling us. Just like the S&P has been range bound for the last couple months, NVIDIA even more clearly so. We've got 170 on the lower end. We've got 195 on the upper end. We have been within that range going all the way back to mid-November. The RSI has been relatively neutral during that period, generally staying between 40 and 60. What happened after the close? We were up a little bit. Looks like we've come off a bit. Right after we were up around 203, 204. We're currently still trading higher, but down around 198. I mean, that's not even above today's high. That's right around today's high. So it looks like in the after hours, we're up slightly, but up slightly, not a huge upside follow through. We'll see what happens tomorrow. After hour session, I think always interesting for like an indicative read on short-term reaction, but we want to see what happens with the full session tomorrow. So Thursday, it's going to be about charting NVIDIA's reaction to earnings. If we do get some sort of gap higher because of a decent earnings report, that would be one of the better things you could hope for in this week with a company almost $5 trillion in market cap. However, the danger here is if we don't get upside follow through on earnings, watch how quickly our major averages can rotate lower. Shout out to a friend and longtime fantastic technical analyst, Nick Glyden. Nick is with Rothschild and Company based in London. I followed Nick's work for many years in my Fidelity days. Always a pleasure to get charts from him. Nick taught me a number of things, but really taught me to respect relative strength as a primary technical input. I kind of understood it a bit going into my frequent meetings with Nick, but coming out of those, I would always be like, wow, I need to really prioritize relative strength. And I took that away. He shared a chart like this earlier and very kindly shared it with me. And I appreciate him doing so. This is a weekly chart of one of the software ETFs. This is ticker IGV. This is an iShares software ETF. Weekly chart going all the way back to the 2009 low. So we're going back to the great financial crisis. If you start a trend line there on the log scale chart, line it up with the 2016 low. Look at how well that lines up with the 2022 low. And look how well that lines up with right about where we're at now. Now, you could argue we're just starting to break below that, and you may be right. But on a long-term chart like that, a little bit of wiggle is to be expected. If you look back on IGV, just above $75 a share has been key support over the last 2 years. We're kind of pulling back to that support and pulling back to this long-term trend line. Is this the point where we have a meaningful tradable low? I think where charts like this are helpful is that they help you understand sort of the long-term story, right? Don't get caught up in the strength of the short-term sell-off, but think about the longer-term trajectory. Nick's point when I heard from him was the difference here is how quickly we've accelerated to oversold conditions, how quickly we retested that support level. Took a lot longer back in like 2021 to 22 to get down to that point. So maybe this time's a little different, but this is a weekly chart I will definitely be following. And again, thanks again, Nick Glyden, for sharing that with me. Netflix having a bounce higher, right? So we talked about some of the semiconductor names, talked about NVIDIA, of course. Netflix, one of the best days I've seen in Netflix. I can't remember the last time it's had an update like this. Back in November, it looks like, right back here, you had a bit of an update pushing above the 200-day. We're way below the 200-day now. But today's rally does push us above the 21-day EMA, which we haven't seen in a couple months. Also, the RSI pushing just above 50. I think this is one day, so I'm trying not to get too excited. For me, a break above the 50-day after being below it for so long can be a really nice upside follow through. Some weakness in consumer staples I have to report to you. Molson Coors, ticker TAP, starting to look pretty ugly post earnings. We had the gap lower on earnings. We did bounce higher off the 200-day, but today, unfortunately, going back below the 200-day moving average. That's not a good look for a stock trying to regain the mojo. It looked like such a good chart going into mid-February, and then it all unwound very, very quickly. RSI for now holding 40, but that's the level I'm watching. Brown-Forman Group, I think, is a chart that is a reminder to be patient. The breakup of the 200-day, pretty encouraging. We talked about that level around 31 to 32. That's the resistance from last summer. That lines up with the highs in December. That lines up with the highs so far in February. We never quite got above there. So today's gap lower is a bit of a concern. They actually report earnings next week, but weakness today, along with a lot of other consumer staples names, it never got the follow through, right? And I think that's why it's important to, when you're looking at a chart, look to the left and see where we found resistance before. Be wary of names that are unable to get above previous key resistance. All right, we got to finish after going through some breakdown charts. Let's finish on a high note and look at Coherent Corp, ticker COHR. This is, they make lasers, and this chart is going up and to the right. Friendly reminder, this is a stock in the technology sector. If you look at this chart, you wouldn't realize what's going on with other growth stocks. You wouldn't be concerned about what's going on with anything else. It's just a good chart. You remember the way I sign off the show every day. It's always a good time to own good charts. It's charts like COHR that come to mind. Now, it's overbought again, which usually means we've had a pretty good run. Maybe in the short term, we pull back perhaps to the 21-day EMA. But strong charts tend to get stronger. Uptrends tend to persist. Higher highs and higher lows. As long as that pattern continues, I think a chart is innocent until proven guilty. COHR appears to fit that bill right about now. Folks, that'll do it for the show today. Thanks so much for joining with me here on the show every weekday after the close. For Chart This with Dave Keller, please take a moment and drop a question in the comment section on our YouTube channel. Again, I'll be traveling the remainder of this week. I am planning to do a show every day, but just be flexible. I'll try to get the show out to you, and I'll try to keep you updated through the YouTube community for any change in when you can expect the show. In the meantime, have a wonderful night. Be well, stay safe, and remember, it's always a good time to own good charts. Take care, folks.